Hey, what's up YouTube? I hope everybody's having a great day. In today's video, I'm going to discuss the difference between a Heloc and a home equity loan and when you should be using each one. If you haven't seen my other videos where I cover how I use home equity loans to purchase real estate, make sure you check those out. So let's dive into it. Okay, first we'll talk about the Heloc. Heloc stands for Home Equity Line of Credit. So home equity line of credit is something that you can get at your bank or a credit union, and basically this is the way that it works. If you own a house, and in this example we'll say this house is your personal residence, and we'll say that this house is worth $100,000, which means that if an appraiser were to come, they would assess this house at $100,000 based on the improvements that you have in it and based on the location and what type of house is sold in your neighborhood in the past, say, 6 months. So what the bank does is, using that appraisal amount, they say, okay, from this appraisal amount, we will give you 80% of the appraisal amount minus your balance. So if we multiply this by 80%, at 80% is $80,000, and let's say you have a mortgage on it with a balance of $50,000. So then the bank would subtract $50,000 and you'd be left with $30,000 of available credit for a home equity line of credit, which basically, the way that it works is, once you apply and you get approved for a Heloc, the bank will allow you to borrow against your house, which means there'll be a lien on your house, up to $30,000. And the way that a Heloc works is much like a credit card. Basically, you have this amount of money that's available to you, and if you use it, then you start to make payments on it. If you don't use it, it's just sitting there and you have available credit of $30,000. Most banks, Helocs, have a variable rate. That means that a lot of times they will advertise a low rate of, let's say, 3%, and that rate will be good for the first 12 months, and then it will adjust to whatever the market rate is. So right now we know that rates are going up, and this is May of 2022. So if you sign up for a Heloc and you lock in, let's say, so if you sign up for a Heloc and you get an introductory rate of 3%, you might think to yourself, wow, this is a very low rate. But 12 months from now, that could go up to 8% or 10% or whatever the rate's going to be at the time. So this is where a Heloc is a little bit tricky, because they do have variable rates. Alright, so now let's talk about a home equity loan. With a home equity loan, the process is very much the same. Let's say in this example, we'll use the same house, and this house will be worth $100,000. Well, the bank will allow you to borrow up to 80%, and this is not all banks, but most banks will. So that means you have available $80,000, and then you're going to subtract whatever your balance is. So in this example, we're just going to say it's the same, and you have a balance of your mortgage of $50,000, and that means you have $30,000 of available credit. So with a home equity loan, you have the option to lock in a fixed rate, basically meaning that you will, whatever they advertise, and let's say I checked some local banks around me. Most banks are offering somewhere around 4 to 5% for a home equity loan. But you will lock in to that percent for the duration of the term. So if you choose to borrow $30,000, 5 years, 10 years, 15 years, some banks even allow you to borrow it for 20 years, you will have a fixed rate for the duration of that loan. Means it will never adjust. Now, what's the difference between a home equity loan and a home equity line of credit? Well, when you take this money, you immediately start to make payments on it. It means they just deposit that money into your bank account, and now you have to make payments on it right away. Whereas with a home equity line of credit, it's basically like a credit card. It's available to you, and you can borrow as much as you need or as little as you need. So you can borrow a couple $1,000s, or you can borrow the full amount of $30,000, as is in this example. Okay, so which product is best? Well, it all depends on the situation. And this is a very common question. Personally, I mostly use home equity loans when I purchase rental properties because I use the BRRRR strategy. Now, Helocs have a place as well. If you need some money in a short term and you're not really concerned about the interest rate being variable, and you want to have the flexibility of, you know, borrowing as much as you actually need and not being locked into a full amount of money and then making those payments for a long time, a home equity line of credit might make sense to you. Let's say if you want to upgrade to a bigger house, you need some money in the short term for, let's say, down payment or to make some repairs. This might be a good option for you. A home equity loan is a good option, like I say, when we use the BRRRR strategy. So when we're pulling equity out of an investment property and we use that equity to purchase our next investment property. So we want to be locked into a fixed rate for as long of a duration as they give us. And typically, like I said, it's somewhere between 15 and 20 years that they allow you to borrow for. But once you take that money out, your payment's not going to be changing. Whereas with a Heloc, you can pay some of it off, some of the balance off, and now your payment is adjusting. So it's very much like a credit card, where a home equity loan is very much like a mortgage, basically. But one thing to note is that whether you're using this product or this product, you want to be careful with what you use it for. Whatever you're going to be purchasing, you want to make sure that it's increasing the value of something, or it's an asset. Meaning that we don't want to use these products to purchase cars or boats or campers or anything like that. We don't want to use these products to buy liabilities like televisions or going on vacations, because these are going against the house that you live in or against an investment property. And basically you're adding that risk on top of the place that you live or on your investment. So you don't want to do that. You want to use these products in order to build wealth, not to become more in debt to things that are losing value. So when I use these products, I'm using them as wealth building tools. That means that when I'm using a home equity loan, I'm purchasing real estate that is creating passive income and also increasing in value as time goes by. So I'm leveraging this money, I'm taking that risk, but it's against an asset. It's not against the liability. That makes sense. And hopefully you guys find this information helpful. If you have any questions, make sure you throw them in the comments below. Hey, well, I hope you liked this video. If you did, make sure you smash the like button. If you haven't subscribed yet, make sure you do that. Hit the notification bell. There'll be more videos to come. We'll see you guys.